if something happens to any one of the owners or any one of the partners, that this buy-sell agreement is already kind of pre-negotiated, lays out the terms on, how you're going to value the company, what the sale price calculation will be, and who has first right of refusal to buy the stock. And because this is an important step for all business owners to take when they have partners, for sure, because you want to do it and you want to hash all this out before things get sideways or before something happens to somebody. And that could be death, that could be disability, or it could be, other circumstances that, warrant that somebody has to be out. So that's a very important thing to have in place. And that is something that should be kind of done at the earliest point you can in your business. Now, the other thing to consider is if you are a business owner and you don't have a partner, so let's just say you're a sole owner, what happens to your business if something were to happen to you? It's going to go to the courts, and the courts are going to figure things out for you, and it's going to be held up for a long time in probate. And then eventually your heirs will get something. In a case where you have a single owner of the business, we still recommend a version of the buy-sell agreement. It's called a unilateral buy-sell agreement. And what this is you're basically pre-negotiating the sale to somebody outside of your company of your business if something were to happen to you. And that could be somebody that and it could be, you might have people picked out that have, a pecking order of who has first dibs at it and who, can come in behind. But this is always a good thing to think about when you own a business and when you start a business, because 100% of business owners are going to exit. 100% of people are going to exit their business when they own a business. So it's inevitable. Why not dictate the terms of that, so that your heirs and your family members get what's coming to them, and they get it in short order. And so, you hear the horror stories about people that have partners and one dies and now they're partners with their ex-partner spouse. And it's not somebody you want to be in, partnership with. So that can create a lot of headaches. So buy-sell agreements are hugely important for people and often overlooked. And so one of the areas where we try to advise our clients is you need to be thinking about this and put something together. And it's best to do it when things are good, and everybody's happy and, they're all getting along.
And do you do something, Mark, where you are able to moderate, maybe, I guess is the word, if a situation happens as far as value goes? Because, one partner could see the value, the very practical value of the business differently than the other owner, especially if one is selling one out.
Yeah.
Have you dealt with that? And if so, how do you deal with those relationships from a professional standpoint?
It feels like oftentimes as business advisors and accountants, we're therapists, right? We have to do a lot of that. This happens a lot in cases of divorce, and also, like you said, businesses that the partnerships, breaking up or something's going on. Doing a buy-sell agreement, again, hopefully you're kind of doing this all at a time where everybody is getting along and things are good. And we hope that that's the case. If it's a situation where it's not and things are going to get contentious, and oftentimes when you have multiple partners, there may be multiple valuations involved. Like one partner will get it done and another one will get it done. And then they'll just kind of have a meeting of the minds where they say, okay, maybe we average it. Maybe we take, one over the other based on what, and so on and so forth. So there's lots of ways to cut it up and lots of ways to do it. When we get into a situation though, where there's a valuation that could be challenged, we tend to bring in a partner that does forensic accounting and that does business valuations. And so they can have a little bit more of an objective view of what the value is. And again, a lot of it is going to be based on the numbers, but there's some subjective components to the valuation that you just have to kind of hash out and figure out, how that affects the valuation of the business. So in cases where there's partners that aren't really getting along or that challenge it or may have different views of what the value are, we can step in and say, okay, here's the things that you can look at. We're not going to do the valuations ourselves. We bring an expert in to do some of that. There's a balance between having a really good tight valuation and, of course, how much do you want to pay for that, right? And so there's some costs to that. So a lot of things to consider when it comes to that, but always best to try to hash it out ahead of time, because when it's too late, it's not a good scenario. We had a company that had 6 owners a long time ago when they were just coming on as clients. And shortly after they came on as clients, one of the owners died. And so now you had a spouse that really wasn't involved in the business that they were now, they owned the business with, and it got really contentious, and it became very expensive to kind of navigate through that and get things to a point where everybody was somewhat happy. Not, they weren't,
Yeah.
but it gets messy. So if you don't work this out ahead of time, it can be a challenge.